Well, we'll just kick off here, I suppose. I am recording this, so if we get the bugs worked out, I guess we can move on from there, and I can
Great.
send it out to everyone interested. Yeah, just wanted to go over the Rule Symposium. I assume you're home, or are you traveling further?
No, I'm home.
You're home. Gotcha.
Home for a little while with the Battle Bank adventure. I'm sort of back on the conference circuit again.
I gotcha. All right.
If you ever want to fail retirement, John, when the time comes, start a bank.
Fair enough. Um, so the first question I just wanted to kind of go over was the Rule Symposium versus the boot camps. The boot camps, I think you got another one coming up actually as well in the end of August. And I kind of wanted just for you to overview what the primary differences, other than obviously in being
The
live in attendance, but perhaps those will change in the future.
the boot camps are meant to be a fairly deep dive into a specific topic. So, as an example, there's a broad audience that is attracted to the silver narrative without perhaps knowing as much about the silver market as they should. You could say the same thing about uranium. So the idea with the boot camps is to give people 8 or 8.5 hours of fairly intensive work on one topic. Not that somebody comes out of 8 hours as an expert, but they come out of 8 hours with a basic understanding, at least of what they don't know, and hopefully the tools to increase their knowledge. The Natural Resources Investment Symposium has a very different idea. The Natural Resources Investment Symposium is meant to, first of all, introduce people to a worldview, a contrarian, libertarian, value-oriented worldview, that if you subscribe to it, you almost have to be a natural resource investor. If you don't subscribe to it, that's fine. Go do something else with your life. If you do subscribe to it, we want to give people tools to increase their effectiveness expressing that narrative in their portfolio. So those would include, analysts like Adrian Day, people who have been translating that worldview into portfolios for 40 years, not people who failed as marijuana analysts, failed as technology analysts, and failed in the crypto business, and so parachuted into natural resources. Two, we try to introduce people at both events, frankly, to living legends, people who have built multi-billion-dollar companies from scratch, either in the boot camps, in the specific area covered by the boot camp, or in the Natural Resources Investment Symposium, in natural resource-based businesses in general. And we try to introduce subscribers to both types of venues, to companies that we think typify the opportunities that we see in the sector. We keep the process as interesting, as honest as we can with exhibitor selection, by saying that they have to meet the criterion that we think are important enough that we own them. At most investment conferences that I've been in attendance at for 40 years, the primary qualification to be an exhibitor was a check that cashed. Yeah. In our products, yes, the check has to cash, but more importantly, you have to be invited to exhibit. We aren't suggesting that every exhibitor is appropriate for every portfolio where the attendee comes. What we try to do at the event is give people an understanding of the criterion that, at a minimum, should be employed with investment selection, and then let the attendees decide both which criterion from their own point of view are important to them given their own goals, and whether, after applying the criterion, the exhibitors that we have chosen to showcase are suitable for them. I should note too, John, that the whole process, the whole live and virtual event process that we are involved in is meant to be used in context with the Rule Investment Media videos, and in particular with the videos at the Rule Classroom. Those are all freeware, and to the extent that attendees avail themselves of, in particular, the mining classroom series like how to interrogate mining company managements, it makes their attendance at either the virtual or the live events much more useful for them, much more focused for them, and probably much more profitable for them. So we're trying to create an integrated whole where we teach investors and speculators in a very broad sense how to be invested in the natural resource business, and then also provide events for them that are much more specific and much more focused. Sorry for that long-winded answer, but it was a big question for me.
Yeah, no, perfect. Did you get any feedback whether people are able to stay more concentrated sitting in a live audience rather than at the boot camps where they might be, distracted by things at home? Have you received any feedback in regards to that?
We have not yet. Every objection that we have gotten to the virtual performance, well, there have been 3 objections. You know that we have a absolutely gold-plated money-back guarantee.
Yep.
Anybody who thinks they didn't give their money's worth emails us, we give them the money back. They don't have to ask us. They don't have to tell us why they want their money back, but we ask them so that we can do a better job for a bigger audience. And there have been 3 types of request. 1, the attendee couldn't make the technology work.
Yeah. Okay.
That would likely be my objection at age 70. I have a rotary brain in a digital world. The second is that the information was more technical and deeper, that they basically wanted to come get stock tips where somebody else did the work. The third was simply that after having been attracted to the format because of circumstances that existed at the time that the attendee subscribed, that their preferences or tastes changed, or they didn't have the time that they learned as a consequence of the video that was necessary to be involved in speculation.
Sure.
My simple admonishment to people that they own a number of stocks that corresponds with the number of hours per month they're willing to spend on their investments was very off-putting to people. They sort of hoped, many of them sort of hoped, and when I say many, the truth is, John, that we have against now almost 8,000 paid attendees across events, had to give refunds back to fewer than 50 people. So when I talk about trends, they're probably not statistically significant, given that 50 isn't a significant data set around against 8,000.
Fair enough. No, that's good numbers.
But the 3 principal objections were could not make the technology work, did not have the background or frankly the interest, given how dense the lessons were,
right,
and frankly didn't give a damn, and weren't willing to spend the time that they came to understand was necessary to participate in the industry as either speculators or investors. Gotcha. And those are 3 valid criticisms. There are a bunch of people in the world who, if they want to participate in the natural resources sector, given that they're not going to put in the time to develop the expertise necessary to compete, should probably buy an ETF, 1 or 2, low-fee ETFs, right. Try and capture as much market beta as they can and get on with their lives, do something else. And if they got that out of the boot camp, that's good enough.
Yeah, I think the best advice I heard, or one of the best advice that I heard, I think you're doing another interview where you said the boot camps will give you enough information that when it goes down or becomes cheaper, that you buy more of said industry. And I think that's pretty good advice, and probably not. Most people just want to take off right out of the gate, start winning, and in this industry, any investing, that's never been true, I suppose. But maybe in recent history, it's kind of been true in some sectors.
I think I should probably do a boot camp, or maybe not a boot camp, maybe something shorter that's free, on the investing lessons of Warren Buffett. He's been a fairly successful guy, first of all, but it's odd that as I age, the efficacy of his technique is just overpowering. That one phrase, that the market is a wonderful mechanism for transferring wealth from the impatient to the patient, is something that I really wish more investors would adopt. Another dictum is that money is made on the delta between price, the share price, and value. That the market isn't a source of information so much as it is a mechanism for the exchange of fractional ownership of businesses. And if you don't have a sense what the business is worth, the price information isn't of much value. A lot of investors and speculators pay slavish attention to price and price trends, but that information doesn't seem to me to have any intrinsic value if you don't have an opinion as to the value of the interest that you're acquiring.
Fair enough. So the symposium has also moved to Boca Raton for the last 2 years. Previously, it was online due to COVID, and it was in Vancouver for a long time. How has the demographics changed? Have you noticed any particular demographic change with that move, and pros and cons in general?
Well, let's do pros and cons first. I dearly love Vancouver in the summer. Partially the conference was there because I like to be there in the summer. It was also useful because there's a lot of exhibitors there. It doesn't take a lot of skill to get people to come to Vancouver because the place is great if you give them a good format. The cons were really, other than the Hotel Vancouver, there isn't an affordable conference facility in Vancouver. If you use any of the Bayshore Hotel, the new convention center, or the old convention center, that has the effect of probably raising the per ticket charge to attendees by $250 or $300. We have a long-standing relationship with the Hotel Vancouver, and the Hotel Vancouver provided good human service for us. They'd hosted the conference for 20 years. They knew how. We knew the catering manager by name. We knew the AV people by name. All that was wonderful. The human part of the Hotel Vancouver was very easy. What was not so good is that the owners of the Hotel Vancouver have not reinvested in the Hotel Vancouver for a very long time. And the rooms that they would describe as quaint, I would describe as borderline. Now, they gave me a very, very nice room because I guaranteed them $250,000 or $300,000 worth of revenue. But the rooms that our attendees had, and I realize that rooms aren't content, but there's just no comparison between the rooms that our attendees were able to enjoy in Boca Raton and the rooms that they inhabited in Vancouver. And the conference facility itself, the Vancouver conference facility, any way you demise it, was chopped up into 5 spaces. And there was just no way for us to overcome that. In Boca Raton, the space they gave us, you saw it. First of all, it was enormous. I felt like I'd leased all of Nebraska. And that ended up being a benefit. Being able to have people in a space that was open but large enough and also comfortable was a very, very, very large difference. The question for me became, given the fact that the rack rate in Boca was somewhere between $1,050 and $1,300 a night for rooms. And we were able to turn the rooms to our attendees for $300. How long could we cause the Boca Hotel to freeze the rate?
Yeah.
And they've agreed to freeze it, effectively freeze it. The rooms are going up by 3%, 10% a night in 2024. That was enough to put me over the edge. That's the answer to the second part of the question. The first part of the question, the demographics. The conference was getting younger at any rate.
Okay.
And I think that's a function of the fact that the conference markets mostly to my own list, and my own list is generated mostly from social media. And the consequence of that is that my own master list is becoming a much younger demographic. South Florida gives us the advantage in that it is, for the physical part of the conference, easily reachable by air from both Europe and Latin America. And the non-US origin live attendees this year were about 25% of the conference.
Okay.
Getting to Vancouver from either Europe or Latin America frequently requires two-stop, change of plane.
Right.
And what that means is that South Florida gave us a much larger exposure into Europe and South America. Vancouver, of course, gave us better exposure into Australia and the Far East.
Fair enough. Okay, very good. How about the coffee? Where was the coffee better? I thought the coffee was quite good at Boca. I can't remember in Vancouver, to be fair.
Vancouverites like their coffee. It's interesting you say coffee. The hotels have taking advantage of exhibitors down to a fine art. And in addition to looking at the overall food and beverage minimum, you have to look at the cost per item. Both hotels at various times have tried to charge me $30 or $40 a gallon for coffee without looking at the fine print. And in both cases, I was able to negotiate them down to $15 a gallon. Both hotels try to slip past the morning muffin at $4 a muffin.
Yeah.
The art of putting on a conference has an awful lot to do with dissecting hotel proposals, literally line by line.
I imagine. We'll say the cookies were good too. I think they made one cookie station that was really good.
I'm embarrassed to tell you what those cookies and muffins ended up costing. It's humbling to know that your food and beverage bill rivals your education bill, your speaker's bill.
Yeah, fair enough. Moving on to the content of the conference, I did not, get to see a lot of it. I was we had a booth brought there.
Yep.
And I was busy with clients in the booth. I did just today get the link to start watching videos, and I started watching videos. I guess, where does one begin? There's days of content. If people were there, they likely took many notes, have many handouts from all the booths. Where does one begin organizing what they just came back from?
I'll tell you what I do. I segregate the notes, the presentations by type. Yep. So the first thing I do is I listen to all the big picture speakers first. I listen to the Bill Bonners, I listen to the Grant Williams, I listen to the Jim Rickards, I listen to the Nomi Princes. Because what I want is to challenge my worldview, challenge and round out my worldview. And I think that's what the big picture thinkers are really about. And I try to find, and I don't always succeed, by the way, 3 themes to agree with, 3 themes to disagree with, and 3 themes to question for every speaker. It's sort of a thought game. Because what I'm really trying to do is avoid the passive consumption of the material in the conference. What I'm interested in is not merely what is said, but how does what is said either reinforce or question the paradigms that I bring to investment selection? It's only after I've done that, the big picture thing, that I try to get more focused, that I listen to the more how-to presentations, the Adrian Day style presentations, the Kim Eskian presentations, the Dan Ferris presentations. I then listen to the Living Legends presentation, because the Living Legends are really where the rubber meets the road. Those are the people who have taken their own paradigm and their own skills through 3 or 3.5 decades, through good markets and bad. Won the Living Legends panel, but then I also, because the Living Legends are frequently CEOs of exhibitors too, I listened to their individual company presentations so that I have a sense of what they're trying to accomplish and how they're trying to accomplish it. After I have listened to a CEO interview with a view to understanding what makes the serially successful CEOs serially successful, then I watch all of the other corporate presentations. In other words, I like to start with the presentations by the serially successful. And I always try to look for two things in the presentations. Companies where my estimation of their outlook was unrealistically optimistic, which is to say that prior to refreshing my memory around the company, there were important things that I didn't know. And I try to look for opportunities, understand that I think I know enough about these companies that either I or funds that I advise own them all.
Right.
But I look for circumstances where there was overlooked good news, overlooked data, where in particular the CEO or the technical people could improve through the presentation my sense of the geology, and more importantly, perhaps my sense of their sense of the geology. You know, John, I've always focused on the fact that in speculation, the process is really involves answering a series of unanswered questions. Yeah. So at this year's conference, I thought I knew a fair bit about meteoric. But when I was able to get meteoric in that little office, and they showed me the cross sections, both in terms of the continuity of tonnage and grade, but also the potential prevalence of feeder systems within the caldera, and also where they explained now that what they need to do is begin to, with broader diameter drill, work on the metallurgy on various lobes of the deposit to see how consistent the process will be. I learned a lot about meteoric, sitting there doing the work myself.
Yeah.
And I think that's important. I think that maybe it's easier. Well, not maybe. I've done it for almost 50 years, so of course it's easier for me. But the truth is that any of our attendees, either live or virtual, can, by going through the presentations of 40 exhibitors, find 10 exhibitors that they want to focus on and get in touch with those exhibitors through the one-on-one mechanism, and come to more deeply understand the company, but also come to form a personal relationship with somebody at the company, so that when they have questions in the future about press releases, that they don't have to rely on guesswork. They can go right straight to the company, and that's critical.
Oh, very good. Continuing with that a bit with the exhibitors, you know, we've worked with you. I've been a Sprott now for 7 years. You were in the office there for a number of those years, most of them. You always been an optimistic person, I have to say. And some of this nature of the presentations were maybe not so much doom and gloom. I listened to Albert Liu and Grant Williams, and it wasn't doom and gloom. They put a very straightforward, very logical case of why, you know, the dollar in Grant's case might lose its reserve currency, and Albert, why governments tend to fail. But when you look at the room of exhibitors, you might not necessarily, and you said before, not every company is appropriate for every investor, but in certain scenarios, and I didn't listen to all the presentations yet, but if someone was very doomy, gloomy, I might want to own one speculation type of investment versus if things just carry on normal, which is always, you were always preaching, the world's going to continue. You're very optimistic. People can consider, in Silicon Valley, Google.
I think the pessimistic investor,
How
and by the
might
way,
one? Yeah.
I've never seen pessimists get rich. I've seen pessimists avoid becoming poor, but I've never seen pessimists getting rich. I think that you hedge yourself against suboptimal outcomes by maintaining a high degree of liquidity, defensive liquidity. And some of that liquidity, I think, needs to be in physical gold or a physical gold equivalent. I also think that aggressive speculators like myself, optimists, need to maintain liquidity, but they need to maintain liquidity for a very different reason. They need to maintain liquidity to take advantage of opportunities that can come from market fluctuations. My maintenance of cash, personally, isn't a reflection of pessimism. I frankly look forward to a recession. I know that makes me an ogre, but I look forward to a circumstance where I know a lot about companies and where I believe, too, in the inevitability of an increase in demand for industrial commodities in particular. And I look forward to the chance, the possibility of acquiring those companies or shares in those companies, pardon me, in a recession or in a recession combined with a liquidity event at some substantial discount to their current prices. I try to get the attendees to understand that none of the living legends, none of the people who have built multi-billion-dollar companies from scratch, a couple of them having made themselves billionaires in the process, got there by being pessimistic. I note too, John, that when I was a office mate of yours, fairly frequently I would conduct informal interviews of our most successful clients. And I found that while they were universally pessimistic about the direction of the economy and humankind, they were universally optimistic about their own businesses.
Okay.
I always found that interesting because communal outcomes are really the results of individual circumstance. I continue to believe myself, believe is a strong phrase, but I do believe, I guess. I continue to believe that the product of our individual effort and tenacity and intelligence will somehow find a way to overcome and finance our collective stupidity. I believe, as an example, that US dollar hegemony is in decline, but the decline will take a long time. I don't think, as an example, that we'll see the end of the US dollar's penultimate reserve status in my lifetime, and I'm 70. I think it'll become less important, and I think that the benefit that the United States derives from the exorbitant privilege will begin to decline fairly rapidly now. I think for Americans, that's unfortunate. For people in the rest of the world, it's a very good thing. We abuse the privilege, and now we're going to have to give it up. But I also note that when I look at the range of alternatives to the US dollar, I don't see any.
Yeah.
That isn't to say that the US economy isn't losing its relative strength. It is. It's just that it starts from such a position of superiority, or rather, all the competitions start with such a position of inferiority, that I think while the US dollar's demise is inevitable, it is not imminent.
Right. Yeah. Agreed. Do you You had something?
No, go ahead.
Do you offhand know who the youngest speaker was?
I'm sorry?
Do you offhand know who the youngest speaker was?
His name escapes me, but he was the first speaker. The the editor for Stansbury, who forecasted very, very high gold prices and a very, very high Dow, I suspect.
Okay. Because I believe, I don't know if it was your conference, I tend to remember there was not, you obviously had the Living Legends, but you also had Up and Coming. Maybe was that, did we have that before at your conference or
No,
not?
we're intending to have up and coming next year. And I need to say in the resource business that the up and comers are in their 40s. You're not going to find them in their 20s and 30s. And that's actually by design. I want people whose familiarity with resources incorporates enough time in a Malcolm Gladwell sense that they have in their 10,000 hours. I want specifically to have people who have practiced what they preach in both bull markets and bear markets. I've seen a few people, myself included, in the 1970s that built big reputations in their first bull market because they weren't constrained by prior mistakes and they were gunslingers.
Yeah.
I did that. And I learned in the next downturn just how smart I was, which is to say, not very. So I don't want to subject my viewers to these flash in the pan overnight successes that really succeeded because of bull markets and an overbalance of testosterone. You know, I want people who have been through bull market and bad.
Very good. And then just some broad questions. Did you have any highlights personally or anyone that stood out unexpectedly, perhaps?
Although he's a real friend of mine, I thought Albert Liu gave a very good presentation. I think it may have been too subtle for people in the audience who were looking for stock tips. But the idea that people cleanse their own information gathering process by visualization, the little trick he did, trying to get everybody at the beginning to think he was referring to China as this oppressive fascist regime when he was referring to Canada, I thought was good. I thought it was funny, but I thought that he was making a larger point. And I think Albert may have been a tad too subtle.
Yeah.
I think it would have been useful if Albert would have done a summary and conclusion and said, I fooled you. This is what I did, and this is why it's important. Don't do this again, you know. But perhaps because that's my style, I didn't find it so. But I was certainly impressed with that. I was impressed as I thought I would be with Bill Bonner's ability as a storyteller to illustrate verbally the messages that he was trying to put through.
Yeah, and any particular presentation that might be useful for new investors coming from other industries, specifically real estate? It seemed like there were quite a few real estate investors there. Was there anyone pointing out some sort of similarities or how to transition? I feel like some people that have success, a lot of success in one area, tend to believe that can instantly transfer into other investment areas or other areas that are life.
I don't think we did a good job of that this year. I don't think we did a good job of that this year. We've done a better job in other years. You normally have to include more generalist material in a bull market. In a bear market, you usually, in a religious sense, get to speak to the choir, which is to say, in a market where the resource thesis isn't attracting a broad following, you can be much more specific in the information that you offer up. You may recall, John, in some of the earlier days of the conference, 2005, 2006, in Vancouver, you know, in that rocking bull market in the 2000 to 2010 era, this conference had 1,000 live attendees. In that conference, you were forced, in good conscience, to do some very, very generalist things. You were, I mean, we had attendees there who had, probably only learned to spell gold 3 days earlier in response to gold moves. And so you had to do a lot more hand-holding, a lot more generalist stuff. Our supposition with this conference was that people who came to the conference in the circumstance that we find ourselves in today probably already had more experience in resources and precious metals. And as a consequence of that, we were looking on building knowledge rather than establishing the knowledge.
Well, from people I met, that seems about right. Yeah. Okay. Did you take any actions from what you learned or what you heard from at the conference? That you can admit to, I should say.
Yeah,
This is
I'm
not
taking
necessarily for
3
advice,
actions
but
right now, which I'd rather not disclose because I don't want competition from from
very
1,000
good.
attendees. There were certainly some companies there whose prospects, while I already was attracted to them, were better
Yep.
than I had understood.
Yeah, I'll say that's
Uh,
true for me with one particular company. If you're
Yeah.
a client, you can call me an ass, but I can't say here.
Right. Yeah,
Right. And I was
I probably could. I don't think that I'm constrained any longer by things like Sprott compliance and securities laws. But the truth is, I'm actively trying to buy shares in 3 of the issuers, and for personal reasons, obviously, prefer not to have competition.
yeah, no, liquidity obviously in these things can be an issue. I was going to open up to attendees. Jacob, you're the only one here. I do have to see what happened. I had a lot of RSVPs and opens of the email. I have no idea what happened, but Jacob, did you take any actions? How was the coffee? And do you have any questions for Rick? You're the
Yes,
lucky worm
I
here.
have a question. It was a very enjoyable conference. And I did a net present value calculation on a particular exhibitor, and I got a little bit confused about my math because I got it trading at a 90% discount, fully risk adjusted with fully discounted. I'm just wondering, like, am I math wrong here?
I didn't find anything that I saw at a 90% discount to risked NPV. I might have risked things harder, or I might have used a different discount. I will admit that when I do discounts, I do a discount matrix. I run a down case, which is generally a commodity price that's 25% lower than the strip. I do a strip case, or if strip isn't available in a commodity, a spot case. And then I do an aggressive case. For me, the aggressive case is often the incentive price necessary to increase industry output. And I also vary the discount rates. In the gold business, the prevailing discount rate seems to be 5%. The argument for that is that gold is in itself an inflation hedge. I think that's a specious argument. I think that they use a 5% discount because if they use a greater discount, they can't get the net present values that are necessary to move product. I think that 5 comes from the investment banks. So why don't use 5? Except in a case where I try to think in my own market how the market might think. What I try to do is I try to use my best guess as to the real rate of return, which is, or pardon me, the real rate of the depreciation of the currency. And I try and do them all in US dollars. So I, as an example, believe that irrespective of the CPI, which I consider to be a conjured index, that the purchasing power of the basket of goods and services that I buy seems to be enjoying, if that's the right phrase, sort of a 7.5% cost escalation annually. Or put a different way, the currency relative to my lifestyle needs is devaluing at 7.5% a year. So for my own calculations, for my own net present value calculations, use a 10.5% discount rate, 300 basis points of real yield on top of the deterioration of the purchasing power. For non-US issuers, I look for the rate of their sovereign borrowing in US dollars plus 300 basis points. So if, as an example, a project is in Niger, obviously the recent troubles there have affected the aftermarket of Niger's sovereign debt denominated in US dollars. That number right now is 13.5. So I would discount assets in Niger at 16.5, which is a pretty ugly discount. So the differences between you and I may have to do with the pricing assumption used in the net present value. It may have had to do in terminal value calculation. It may have had to do with a discount rate, or it may have had to do with discrepancies in how we're risking the information. I have never seen 3 independent valuations, and I've tested this a couple times, that were within touching distance of each other.
In your classroom, have you done an NPV model and ran through it?
No, we've had a really tough time with that. Albert and I have had a couple dry runs in the introduction to valuation. And the outline of a valuation course, Albert asked me to do a half hour on valuation. And I'm afraid to say that the introduction to valuation consumed half an hour. And it looks as though the best that I'm going to be able to do is between 6 and 8 hours. And we're exploring doing that as a collaborative event with the Colorado School of Mines.
Oh, okay. Yeah.
I think that'd be useful. There's some youngsters there in the MBA program that I've been corresponding with informally around valuation. And I must say that the Colorado School of Mines has something to teach me in terms of the integration of technical data with financial data. But I think I have something to teach the Colorado School of Mines about relevant financial data.
For sure.
They are so ridiculously academic and models oriented that I think they need a reintroduction to the idea of turning rocks into money.
Yeah. Very good. Jacob, anything else on your side, Jacob?
Yeah, I was actually earlier today, I was looking for the US denominated bonds of various sovereign nations, and I had a little bit of trouble figuring out are there a good place to find these? And I was wondering about the duration to look for.
I get them from Bloomberg. I don't know if it's available in the free Bloomberg service, but you can find a sort of a montage of sovereign debt on Bloomberg.
Thank you. I assume you look at the yield, or do you do the
All right.
Yeah, both naked and YTM.
All right. Well, Rick, thank you very much for your time.
Pleasure.
I'm sorry for all those who weren't able to join. Other technical difficulties.